and Legacy is a fully regulated provider. If you can't access their website during a class, it means that they are not registered or regulated in your home country, and they only offer services where they are regulated. Now, if you like during class, you can go to www.legacyfx.com and set up a free demo account. There's no deposit, no credit card required, and you can follow along using their charts on their incredible platforms. Now, Legacy offers 4 different platforms. You can use all of them or none of them or one of them. You decide how you want to trade. You can use their web trader, which is a simple username and password login. You can download the MetaTrader 4 platform for the most professional environment. You can use their mobile trader on your mobile devices anywhere, or you can use their Sirius station for one of the most up-to-date trading platforms with a wide range of advanced features. As you can see on your screen, everything on their platform is easy on the eyes and user-friendly. And you can customize everything on the platform to fit your type of comfort level. Because the LegacyFX philosophy is simple: offer focused and personalized service that makes trading logical. Legacy cuts through the excessive jargon and provides financial content in a language that is comprehensive to all. And they want to educate you. They have a very broad education center because they want to see you successful in your trading endeavors. They offer a full range of deposit and withdrawal methods depending on your home country. You can sign up for their LegacyFX Pro Rewards program. They have incredible security to make sure all of your trades are safe and secure, all of your accounts are safe and secure, and all of your data is always safe and secure. And they offer their entire full range of trading academy. Now, since Legacy is a regulated provider, I am required to give you a risk warning. So I'm going to read the first paragraph, and I would appreciate if you could read the rest that's on your screen. Spread bets and CFDs are complex instruments that come with a high risk of losing money rapidly due to leverage. 76% of retail investors' accounts lose money when spread betting or trading CFDs with Legacy. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Now, today's class is being recorded. If you wish to see a recorded version of today's class, you can do so in about 24 hours by using the same link you used to attend today's class. Or when investing.com has had time to edit it and clean it up, you'll be able to find it on the investing.com website under the Education tab and then under Webinars on Demand. And in fact, there you can see all the webinars we've offered over the last 7 years and pick and choose which ones you want to watch and watch them at your convenience. So let's get started with our discussion on Japanese candlesticks. Now, in today's class, I'm going to use the term security, but I might say Facebook, I might say Google, I might say Bitcoin. I know I'm going to say the euro, but I'm not talking about any specific instrument. I'm talking about all financial instruments that are traded in the open marketplace. I also intermix the terms investing and trading. Typically, an investor takes a long-term position while a trader takes a much shorter-term position. Now, we know the difference, but it gets very, very boring saying trading, trading, trading. Now, whenever I go to a seminar, whenever I'm giving a webinar, when I go to a conference, when I'm meeting traders one-on-one, see, the first thing people ask me is, what should I buy today? And of course, what should I sell today? What will prices be tomorrow? I can't tell you how many people have asked me in the last week, do you think Bitcoin's going to go back up to 10,000? Do I think the S&P is going to recover? Do I think the FTSE is going to get back on key? And where do I think the pound's going to be? Well, wouldn't investing and trading be easy if we knew the answer to these seemingly simple questions? But I don't have a Ouija board, and I don't have a crystal ball. Neither does anybody else. So if you're attending this class in the hopes that technical analysis and use of candlesticks has the answers to these magical questions, I'm afraid I have to disappoint you, it doesn't. However, If you're attending this webinar with the hopes that technical analysis or chart analysis using candlesticks will improve your investing, I got good news for you. That it surely will. Now, candlesticks have been around for a very, very long time. In fact, since the 17th century. Candlestick charting was used by rice traders. And it didn't come to the Western world till much, much later. Now, when I started trading back in 1972, yeah, that's a long time ago, and I was just trading agriculturals, all of us did hand charting. We sat there with a clipboard and graph paper, and we drew on our graph paper everything that came through on the ticker tape. We didn't have computers, so to speak, in those days. There were some brokers had these huge rooms that had this great big air-conditioned computer in there that, they were the old MS-DOS with the green screen, and it took a whole processor, and all it could do was kind of conjure up and figure out all the data that it put in there. There was no internet. There was no live feeds. So most of us charted using bar charts, only because they were a lot easier and faster to do. And if you were trading 6 or 7 assets, and even though the markets were a lot slower, when the prices came through every 10 minutes, 15 minutes, you didn't have hours to draw, because you had to draw each of these by hand. But with the growth of online trading and the development of Java and HTML charts, candlesticks have become the most popular charting method. They are the buzzword, excuse me, for online traders. Now, a lot of people get themselves in trouble because we have candlestick charts, we have candlestick pattern recognition, and we have candlestick analysis. And what happens is too many people think that reds or green candles are telling you to buy or sell. And that is far from the truth. So let me pop up a live chart here for us for a second. So this is my standard teaching charts, the Euro US dollar chart, 30-minute chart, and it's a candlestick chart. And lots of people just think by seeing lots of green, it means to buy. Lots of red would mean to sell. But it's not. It's far, far, far from the truth. Now, candlesticks have several factors. First of all, having these green and red candles can help you see relationships between specific prices. It lets you see patterns that are happening. But candlesticks on the whole have very little to do with the amount of red and green that you see. Candlesticks are more about the body of the candle, or the shape and the size of the candle, and its placement in the trend, and what that shape is telling you, and what the combination of candles are telling you. There's very little to do with how much red or green you're seeing on a chart. So first, let's talk about what the body and or how you actually put together things to be a candle. So let me get these drawings off of here. And let's go back to my PowerPoint. Okay, so what makes up a candle? It's not very complex and very complicated. We put a line across at the open. We put a line across at the close. We put a dot at the highest price that went in that time period, and a dot at the lowest price it hit during that time period. Now, if it's a 1 hour chart, we do this every 1 hour. It's a 15-minute chart every 15 minutes. If it's a 1 day chart, once a day. We then connect the lines to each other, and then we connect the lines to the dots. And then this is known as the body of the candle. This is known as a shadow or a wick. And this is known as a shadow or a wick. Now, if we step up from the open to the close in that time frame, we would fill that candle in with green. If we step down from the open to the close, we would fill it in with red. So red tells us it was a bearish time frame, and green tells us it was a bullish time frame. Now, I'm going to give you a little bit of side information here. It's only something for you to put away in the back of your head somewhere. Lots of times you hear about black candles and white candles. Well, in the old days, we would put a line across the open, a line across the close, a dot at the high, a dot at the low. Connect the lines to the candles. And if it was a bullish session, in other words, price moved up the ladder in that time frame, we would just leave the candle alone. If it had been a bearish session, in other words, price moved down from the open to the close, and it's got nothing to do with the highs and lows. If it opened here and closed here, we would then use the side of our pencil and fill this candle in. So a lot of times you'll hear about white candles, which would be the candle. It's not really white. It means it wasn't filled in. And a black candle, that's the side of your pencil. A black candle would have been bearish. A white candle would have been bullish. Okay. Today, they are green and red. But a lot of names of specific designs of candles were named before we had these computerized charts. So you'll have 3 black crows, 3 white soldiers. So you have to understand 3 white soldiers today could be 3 green soldiers. So keep that in mind when you're looking or reading about candlesticks. Now the fact remains, right now we're looking at a chart, and I'm going to mess up my chart for you. And we're going to go to settings, and we could change the bodies to purple, and let's pick another weird color, purple and pink. Now we have purple and pink candles. As long as we knew which one we said is bearish and which one we said is bullish, that's all that makes a difference. It doesn't have to be red and green, black and white. Today we can do whatever. So if you knew that the dark violet was bullish and you'd set the light pink to be bearish, you would know the difference. It's all that counts. So now let's take it back to where it should have been. Uh-oh, did I do that correct? Nope, did it backwards. Okay, and we're just back to where we started. It's an unimportant thing. So now that we understand how we make the candle, we have to start understanding what these weird things are. Because why is one thing like this and another one like this and one like this and this? And this is where we start getting into reading candlesticks as opposed to just putting them on a chart. Now, granted, everything and anything we do on a chart falls in the field of technical analysis. I don't use the term technical analysis often. I use the term chart analysis because it's basically everything and anything you do on a chart. Now, we need to talk about what the shape and the size of the candles do tell you. So there are really some basic, simple stories. You should be able to look at a candlestick and right away tell who was in control of the markets. Because you only have two choices. Technically, you have three. It can be the bulls, it can be the bears, or it can be undecided. When you get a small body candle, this is telling you the open and the close were fairly close to the same. That tells you nobody was in control of the markets. It denotes uncertainty or indecision. Now, as you can see here, we have lots of ones that have long tails in either direction. And that tells us that at some point, the bears were able to yank the price down, but they couldn't hold on to it. It went right back up and closed near where it opened. So if you imagine this as a battle, a tug of war, I don't know how many people play tug of war. Most of everybody's heard about it. A tug of war used to do at a picnic, and a whole bunch of people get a rope on that side, and then some more people get a rope on that side. And a lot of times you'd have a stream in between or a pool in between. Okay. Sometimes you have a patch of mud in between. And the people over here would tug and tug and tug, and they would try to pull the people over here into the water. And every once in a while, somebody would stumble and they'd succeed. And then this side would push back. And eventually they would end up here and here, and they'd end up where they started from. Now, maybe sometimes they yanked really hard and they pulled two people back in the water. Maybe this guy at the back of the line here, he got distracted by some girl over here, and he didn't pull on so hard, and before they know it, they all got pulled in, but then they pulled back. Okay, and that's what this is. It's a tug of war. So does this tell us a lot? Maybe it tells us the guy at the end over here got distracted, and so these guys were able to pull down. But at the end, they balanced out. Okay. Maybe somebody needed to stop and go get a drink, so they only have 5 on one side and 4 on the other. It's unimportant. Now, there's all types of strategists who will tell you all types of things about these. Okay. But in the essence of our type of trading, doesn't tell you much. So you have even body or normal body candles, which tells you here what? This is a white candle. A white candle is equal to come on, you got it, a green candle. So this tells us that the buyers were in control and they ended up closing pretty close to the highest they ever got. And so that means they were still pretty much in control. Here you have just the opposite. The bears were in control. Here you have indecision and nobody was making any move. Here you had the bears sell, but they petered out and it ended up here with a lot of indecision. But these are the only real choices you have. But it tells you something important. It tells you if somebody is in control of the session and what they were thinking. Now, there are some unusual candles. The one you're looking at on the screen right now is called a Marabuzo. Can anybody tell me what is unusual about the Marabuzo? It's got no wicks. What that tells you is in that time frame, when you have a white Marabuzo, that the bulls started out that minute that time frame opened, because there was never any low, and pulled the price all the way up, and they were still running full steam when the clock ticked out. So that candlestick ended only because the time ran out. Well, that's going to tell you that the next candle should continue running that way. If you get a candlestick that was only full of indecision, you got to question, because here, yeah, the bulls might have tired themselves out, but they should have still had the effort to be able to keep pushing and pushing and pushing. If you got an indecision candle, it's telling you something might be wrong with that push. So it's pointing something out to you. Now, if a Marabuzo appears coming off of a downtrend and you get a bullish Marabuzo, That is telling you, now this is, you notice I told you two specific things. It's coming off of a downtrend, and it's a bullish, the opposite of the direction trend is a Marabuza. Is telling you that you are now moving into a trend in the opposite direction. You're moving into a bullish trend. If you get a bearish Marabuza in the middle of a bearish trend, a bullish trend, that's telling you you're moving into a bearish trend. But it means that you must have these pieces of the puzzle put into place. Now, spinning tops happen quite often. The spinning tops are more about placement than they are about the indecision to spiral this, because they're spinning on top of here. A spinning top would appear, or it looks like it's spinning above the last previous candle. And then we get one of the most talked about candlesticks of them all, doji. A doji tells you total indecision. Now you have to understand the rules for the doji used to be very specific. This used to be what a doji had to be. It means the open and the close were the same price. It means they could have pulled the market up a little bit, down a little bit, but it closed at the same price. Well, years ago, before we had online trading, before we had Forex trading, before we were able to trade 4 digits over to the right, and you were looking at a stock or a commodity was trading in, moving very slowly and trading in fairly large increments, that it was easy to open and close. Google opened at 164.25 and closing at 164.25 is easy. But the euro opening at 131.042 or 1.310492 and closing at 1.03492 is very unusual. So doji was redefined that the open and the close had to be almost exactly the same. Because you could say the euro opened at 132 and closed at 132, but we don't talk about the euro that way anymore. We talk about the euro being 132.09413. So that's a small little pip all the way over to the right. So a doji is a tiny body candle, and it shows complete indecision in the marketplace. Now, you always have to be aware of where these candles, especially these specialty candles, form in the middle of a trend and where they are in a trend line. Because even though they have some general definitions, a doji appears quite often in an everyday trading. Now, if a doji appears after a very large candle, it's more important than a doji just happening to appear. And if it appears near or at the beginning or the end of an uptrend and near the trend line, it would have more validity. So it's key with the doji is that neither the bears or the bulls have gained control and the price has ended where it began. It's a sign of indecision in the marketplace. But a lot of times you have to look at where it forms and then also the quantity or what happened with the wicks or the tails. So here we can see that it formed right by the trend line. Here, formed a little off the trend, but you see how the wick pushed all the way up to that trend line, wasn't able to break up, wasn't able to stay sustained, came back down here, and the price continued in its downward trend. So we need to look out for where dojis are forming or these specialty candles. Now, personally, I place no validity whatsoever on what we call the tails or the wicks. Okay, because you can have all freaky things in the market that push the price up for a second and it went right back down to where it was. But now they have a basic idea of what candlesticks indicate with their bodies and wicks. Let's cut our teeth on some simple and uncomplicated candlestick patterns. Most of these will appear during a normal trading session. Now, if you look on your screen, there are two handouts I gave you. One's called the candlestick cheat sheet. There are 16 primary candlestick patterns, and this is called pattern recognition. This is how candlesticks are taught. Okay. Everybody should kind of know it, but it really doesn't help you in much of anything because candlesticks rarely do exactly what the patterns say, or you don't really see the pattern. Or there's some patterns you do see, like bullish engulfing and bearish engulfing are very, very important, and they happen quite often, and they're very telltale. But things like the star position, they don't help us much. Shooting stars, inverted hammers happen quite often. They don't tell us that much, and it has 51% this way and 49% that way. But you still should memorize the basics. I don't use them in my trading. Okay. Most people today don't get involved in pattern recognition because the markets today move too fast, and too many of these patterns appear all the time. But you should understand what a hammer is, what a hanging man is. You should understand what a harami is. Okay. These are general basics that you should know. But the one you'll hear about, and the one that we rely on the most, that happens quite often, is the bullish and bearish engulfing. So we have three types of shapes or patterns. I didn't name them: the lonesome cowboy and 2 for tango and 3 musketeers. I got this chart off of somebody's website. But we have 1, 2, and 3 candlestick patterns. Like the Marabuja, the Doji, the Hammer, the Hangman, they're all single candlestick patterns. So they happen quite often as one candlestick popping up. The next are 2. It takes 2 candlesticks doing 2 specific things to tell you something. We have bullish engulfing and bearish engulfing. We also have bullish tweezers and bearish tweezers. I pay no attention to tweezers. Then from there we go to 3, which are morning stars, the evening stars, 3 white soldiers, 3 black crows, 3 inside up, 3 inside down. They are significant when they happen, but the significance doesn't carry enough to make them 100% reliable. But bullish and bearish engulfing are important, and that's why I gave you the cheat sheet. You have it there. You can download it. Just click the download button. It's just a JPEG, and then you'll have it, and you'll be able to see which ones, and you'll have the interpretations of them. But bullish and bearish engulfing, I want to spend a little time with you, and I've got I think I have a presentation for you. Yes, and we're going to talk about engulfing and reversal candles.
Using candlesticks in conjunction with each other can indicate market sentiment by highlighting a shift in power between the buyers and the sellers. Candlestick patterns can therefore provide signals such as a reversal of price action. An engulfing pattern is a strong reversal signal made up of 2 candlesticks. There are 2 types of engulfing patterns: a bearish engulfing pattern and a bullish engulfing pattern. There are 3 main characteristics for spotting these patterns. The market must not be ranging. There has to be an uptrend or downtrend preceding the pattern, even if it is short-term. Secondly, the body of the first candle must be smaller than the body of the second candle. It is not necessary for the second body to engulf the actual wick of the first candlestick, although this does create an even stronger signal when it does. And finally, the second candlestick body must be opposite in color to the first candlestick body. For example, if the first candlestick is bullish, the second candlestick must be bearish. Let's have a closer look at the characteristics of a bullish engulfing pattern. You can see in this example, the market is in a downtrend. Notice the highlighted area where the first candlestick of the pattern is bearish, shown by its orange color. The second candlestick in the pattern is bullish, indicated by its blue color, and engulfs the body of the preceding bearish candlestick. These characteristics signal the reversal of the downward trend to the upside and demonstrate how the bears were overpowered by the bulls. Let's now have a look at the characteristics of a bearish engulfing pattern. You can see in this example the market is in an uptrend. Notice the highlighted area where the first candlestick of the pattern is bullish, shown by its blue color. The second candlestick in the pattern is bearish, indicated by its orange color, and engulfs the body of the preceding bullish candlestick. These characteristics signal the reversal of the uptrend to the downside and demonstrate how the bulls were overpowered by the bears. Tweezer patterns are formed by two candlesticks that have matching highs or lows. As the two wicks have the same height, it has the appearance of a pair of tweezers. A discrepancy of a few pips is acceptable. There are two types of tweezer patterns, a tweezer top and a tweezer bottom. As with the engulfing candle patterns, there has to be an up or down trend preceding the pattern. The market must not be ranging. Tweezer tops are formed by two candlesticks that have matching highs and can help spot a trend reversal. You can see in this example that the market is in an uptrend. The upper wick of the first candle shows signs of the buyers losing momentum. The upper wick of the second candlestick in the pattern represents a second attempt by the buyers to continue pushing price up and then being overcome by the sellers. The wicks are of equal length and the highs are at the same level. These characteristics can signal the reversal of the uptrend to the downside and demonstrate how the bulls were overpowered by the bears. Tweezer bottoms are formed by two candlesticks that have matching lows and can help spot a trend reversal. You can see in this example that the market is in a downtrend. The lower wick of the first candle shows signs of the sellers losing momentum. The lower wick of the second candlestick in the pattern represents a second attempt by the sellers to continue pushing price down and then being overcome by the buyers. The wicks are of equal length and the lows are at the same level. These characteristics can signal the reversal of the downtrend to the upside and demonstrate how the bears were overpowered by the bulls. Keep in mind that the bodies or wicks do not have to be exactly the same size or even in consecutive order. Here we see a tweezers pattern with a candlestick in between. The important aspect when looking for a tweezers pattern is two wicks with equal highs or lows, indicating that either the buyers or the sellers were eventually overcome after a trend, indicating a potential reversal.
You've absorbed a lot of stuff at the moment. And you say, how am I going to memorize all these patterns? How am I going to fit this into my trading? This is all very difficult, very time consuming. Well, as I mentioned, pattern recognition is not something we should be doing. It's memorizing patterns and memorizing what they're supposed to tell you and making you very mechanical and make you make more mistakes than you will, making good decisions. Now, there are many ways that we can use candles. We can incorporate them into strategies. Like if you come to our class on indecision candle trading strategy, we're looking for only one type of candlestick at a very specific happening or a very particular event. And that tells you something or it's part of a strategy. Now, it is important to understand what candles are telling you. So there's some easy ways to simplify this. And one of the ways comes from investing.com. If you go to investing.com website and just click on the charts and click on candlestick patterns, it will pop up every asset and show you precisely where a candlestick pattern either developed or where one is developing in the future. Now you can set this up as a customized scanner for yourself by just clicking on what time frames you're interested, what type of candles, what pattern indication, how important they are, and click on apply. And you can customize it all, and it'll send you notifications, especially when you're looking for a 3 or 2 candlestick pattern. It'll tell you that the Euro US dollar 15-minute chart in this time segment just finished an engulfing candle. Okay, and it's gonna be the same on everybody's chart. So now you've got something notifying you. You go to your charts and you can see it. You can also, it will print you out a list of every pattern that you've picked and every asset, and you can see exactly when they've developed, how important they are, and what to do with them. Okay. And you can have emerging patterns, or you can have patterns that were just developed, and it tells you what the pattern is and what what the definition of the pattern is. So it makes it an easier way to incorporate. Now, there's all kinds of scanners you can add in. Okay. You can also go on to their candlestick charts and just roll over the chart and it'll pop up and tell you when the patterns, but we're only really concerned with the patterns developing at the wall. So we're more concerned with those developing patterns very close to the end. Now, another way to do it, and it doesn't involve investing, is let's go back to my chart. So we're at the Euro US dollar chart. And if we go up to indicators, we can go into the public library and we're going to scroll down and we're going to look for candlestick pattern recognition. And no matter what chart you're using, you'll have it. Click on it. And now it's made a mess of our charts. And you can see every pattern that's developed on the charts. We say that's a little bit too difficult for me to deal with. Well, if we go to settings, we can then go back and determine what type of candlesticks we're interested in. Like, I don't trade from the doji. I don't care about evening star, morning star, shooting star. I don't care about hammers. I don't care about inverted hammers. I don't care about haramis. I don't care about bullish. I care about bearish and bullish engulfing, piercing lines, maybe a bullish kicker. Don't care about hanging man. Don't care about cloud cover. And I can eliminate all those. I can also determine how I want them placed on my charts. Do I want them below or above where they're happening? Do I want them in red and green? Okay, so I can decide I only want these in purple, and I don't want to just place a circle on my chart. And now I have my little circle with my bullish engulfing, and I can see them. So you decide. It allows you to set it up the way you want it. See, most of all that other stuff is gone. But you see how often in a day's trading an engulfing candle does happen. But look at that. Most of the time when you get one and they're significant, look at what happens. You get engulfing candles quite often and nothing will happen. But when you get them right on a support or resistance line, they can give us some important information. So adding them into your trading is never a bad thing, but wasting a great deal of time on pattern recognition or memorization isn't a good thing. It's like, in school they taught us our multiplication tables. 1 times 1 is 1, 1 times 2 is 2, and you memorize them. But once you got past that, you had to learn how to interpret them and read them and how to use them in everyday life. And we had to go way beyond 1 times 1, and you had to be able to calculate 99 times 500. And once we know the basics, we can then start doing the rest of them fairly easily. But these are 2 ways that you can find these pattern recognitions easier. Okay. Now, there are other ways that we can use candlesticks, and I'm going to share with you a little way that you can analyze price and price movement, not by memorizing pattern recognition, not by memorizing a pattern, but actually incorporating these into your trading in a very easy fashion.
Now, the core of this strategy relies on the concept of momentum loss, shown through candle sizes and shapes, which is a very powerful price action technique. Here we have the Kiwi dollar. So if you've watched our other videos, we always want to identify key levels first. And as you can see, we have a level of support here, where price hit and reversed from. And now we are back here again. Now, here's a very key point you need to know in order to spot high probability reversal trades. We want to see candles getting smaller and smaller as they approach a level of support or resistance, because it shows that price is losing momentum. Very key point. You want price to be losing momentum and slowing down as it approaches key levels. Now, as price approaches this level of support, look at how the candles behave. As you can see, we have a big candle, followed by a smaller candle, followed by an even smaller candle, another smaller candle, and then a smaller long wick candle rejecting support. And then finally, an even smaller green candle that is also a doji and also an inside bar, which is a reversal candle. And this results in a bounce upwards. So I'll show you this again on another pair. Here we have the Aussie dollar. This is a key level of support. As you can see from when price got here last, it hit and reversed upwards. So as price approaches this level again, we have a big candle, then a smaller candle, an even smaller candle, which is also rejecting support. And then we have this beautiful green long wick candle rejecting support. And then followed by another great inside bar candle rejecting support as well. And as you can see, price bounced upwards, which would have presented a great trade opportunity through the intraday timeframes. So when approaching support, what these smaller and smaller candles show is that the sellers and people shorting the market are losing steam, meaning some sellers might be taking profit as they notice this level of support, which causes these smaller candles. So let's jump to another example. Here's the Kiwi yen. As you can see, we have a double top here before price tanked down, making this a key level of resistance. Now, as price approaches this level of resistance again, look at how the candles start acting. We have a big candle followed by a smaller candle, followed by a smaller red hanging candle, another hanging candle, and then a candle where the wick is rejecting this level of resistance before dropping down, which was another great trade opportunity. Here's the CAD Swiss. Again, we have 3 rejections of this level before it reversed downwards, which makes this a key level of resistance. As price approaches this level again, we have a big green candle, a smaller green candle where the wick is also rejecting resistance, and then an even smaller candle which is a red bearish candle, and as you can see, price reversed downwards. Now here's a pro tip. Look for a candle color change at support or resistance, which can signal a possible trend change. I'll show you what I mean. So as price is moving upwards, notice all the green candles. Green candles represent bullish price action. As you can see, there's 8 green candles in a row before finally a red bearish candle appears. And the most important part is that it occurs right at resistance. And as you can see, price then reverses. Now, in the following examples, I'll show you price action you want to avoid.
Now, you could say to yourself, well, that's incredible. You can always make up charts to show that. How do I do it in my everyday trading? Well, this is the current Euro US dollar 1 hour chart. This is a current chart up to the minute. Look at the gold circles that I've given you that you could have used and spotted this with candles. Here is, in this time frame here, we can see, hold on a second, right here, look at all the green candles. What's happened is bigger candles, small candle on resistance, and it turns into a downtrend. Here we get the same exact opposite thing. And these are kind of engulfing candles. Okay. But there are many ways that we can incorporate the use and interpretation of candlesticks into our trading strategy without sitting here memorizing patterns. Okay. Like I said, you can have the inside candle trading strategy. You can have the indecision candles, but you have to have rules for those strategies. And there are many ways that we can use candles, but please don't get into memorization and don't get into counting reds and greens. Okay. But practice. And as a charting technique, they are a great way to chart. So remember, we have candlestick charts, which is one way of it. We have pattern recognition, and then we have price analysis by reading the candles. And being able to read the candles and understand what they're telling you is the key to everything. Used with other indicators like support and resistance, with a particular RSI or stochastics or MACD, you can make it into a very nice trading strategy. But understanding what a candle is telling you and being able to read price action is about the most important thing you can do. So once again, thank you for supporting us. If you want to learn more about candles, you can go to LegacyFX and they have lots of information for you. And you'll be able to learn all about how to incorporate candles into your everyday trading. So thank you very much. Stay safe and healthy during this pandemic that we're having, and at least use your downtime to get educated. Spend your time trading on a demo platform. Spend your time coming to class. Spend your time testing your strategies, and turn this time into something valuable. Thank you very much, and we'll talk to you again real soon. Bye now.